Hi, everyone. I'm very honored to be here to speak about Neuberger's ESG and climate-related capabilities. Let me introduce Neuberger very quickly. Okay. Neuberger, if you don't know us, Neuberger Berman, we're a privately owned, 100% employee-owned investment manager. And an active manager. And we think our ownership structure, being privately owned, allows us to invest for the very long term, and that matches financially material climate-related factors, right? And so we think that's a unique asset. And our assets are split across both private equity, fixed income, and equities. We're considered and honored to be rated by the UNPRI as a global ESG leader. They have rated us as having 5 stars across all asset classes. It is an accolade that they have given to historically about 20 asset managers globally, less than 1% of all global asset managers. And we think the benefit of an active management approach from an ESG perspective is that you get to interact with boards and management to truly understand if they have the cultural willingness and the technological capability for the climate transition. And I'll explain that in a little bit, that we think ESG is both a quantitative process and both a qualitative process as well. And of course, we offer a range of ESG products across both ESG integration and sustainable and impact products. And I'll explain a little bit of that and how it relates to climate factors in a second. So let's take a step back, right? What is ESG at the end of the day? ESG, as it relates to climate, is about measuring factors that historically have been really difficult to measure, right? And as disclosure improves, as frameworks improve, the measurement gets better. When you think about greenhouse gas emissions, Scope 1, Scope 2, 3, there wasn't a framework before, right? And so now with the advent of ISSB and the standardization of ESG disclosures globally, Hong Kong's going to adopt it starting next year. You're starting to see better measurements as well. However, I humbly believe that despite having more data, you will always need qualitative judgment as it relates to measuring the willingness and the capability of a company to transition. In my previous experience as a research analyst and portfolio manager, I met many senior management teams that had very beautiful ESG reports, glossy 100-plus page ESG reports. But if you really ask them to dig into the details around ESG, either they didn't have the background, nor you could tell did they really believe in ESG. So I think that qualitative judgment is critical to how we assess companies as well. And ESG is about finding great companies, right? Sustainability is really hard. Creating a zero carbon product requires a complete change in your supply chain, in the legal frameworks. And so what it tells you about a company is that they're truly nimble from a cultural and organizational behavior perspective. Again, something that's really hard to ascertain in a quantitative way. And so ESG at the end of the day is about finding the best companies from my perspective. And those companies that take advantage of green opportunities, right? And then those companies that plan over the long term through a climate transition plan to prevent or to mitigate against climate-related risks over time. I think it's really important to understand the different approaches of ESG from an investment manager's perspective. And I think there's a lot of confusion in the market about this particular concept. And it's actually probably one of the most important slides, is I believe there's a range of ESG, starting from ESG integration all the way to sustainable or impact over time. Why do you need a category for ESG integration from my perspective? As a former research analyst, going through financial statements, building financial models, analyzing ESG factors requires an extra 30% of your time. Why 30%? Because historically, analysts, don't read ESG reports, right? They haven't been used to going through that nor do they have the education to go through that. But there's such a treasure trove of information in ESG reports and how to think about linking those two factors together and thinking about in the future, for example, I believe every research analyst will likely have a line for carbon taxes in their financial models, right? And that how that affects their discounted cash flow and their valuations will be a normal part of fundamental analysis. So ESG integration is an investment process, but you need to differentiate that between more advanced forms of ESG where you tilt towards best-in-class companies, sustainable or impact. So from a climate perspective, what a climate fund is trying to achieve is achieve an outcome. It's less of an investment process. They're trying to redirect capital towards the greenest activities or towards transitional activities, which I'll touch about in a sec. So I think it's really important to understand this difference. And to be fair, a lot of the politicization of ESG globally and in the US results from this confusion of integration, ESG as an investment process versus trying to achieve an outcome. So we help a lot of our institutional clients in how to set net zero targets and think about climate-related factors. And usually there are two camps. The most advanced asset owners focus on potentially have a net zero commitment. So a lot of our European clients, particularly the Nordic, Australian, and some states in the US have net zero commitments where they essentially are looking to put a constraint on the portfolio, usually through carbon intensity or carbon footprint. And I'll explain that in a little bit. For those clients or institutional investors who don't yet want to set a net zero commitment, they just want to understand how to integrate climate-related factors into their investment process. They just want to be climate aware. And we use a metric that's well known called climate value at risk, and we've built a strategic asset allocation model based on that. A little bit about the Paris-aligned model and the framework, or the net zero framework, right? An asset owner, an investment manager, and Neuberger is part of the Net Zero Asset Managers Initiative, calculates its carbon footprint or intensity in 2019, and you have a goal, a KPI, of reducing that carbon intensity or carbon footprint by 50% by 2030. Why do they pick 2019? Because the implied reduction in your carbon emissions from 2019 to down 50% and then to zero in 2050 aligns with the carbon budget of the Paris Agreement. The Paris Agreement says we have about 400 billion tons of carbon emissions left that we can emit as a globe before we break through the 1.5 degree limit. The world emits about 50 billion tons of carbon emissions per year. So by that math, we have about 8 years left. So that's why you need a dramatic reduction by 2030, which is the 50% reduction that everyone talks about. And there's usually interim 2025 reduction by of 25% as well. So let's talk about the two key metrics that investment managers, asset owners focus on to carbon footprint their portfolios. There are two kinds. Each have pros and cons. On the left side is carbon intensity. Carbon intensity is the weighted average, or for a company, it's the carbon emissions per dollar of revenue. So it's from the companies, it's from the corporation's perspective, right? And if you calculate the carbon emissions per dollar of revenue in a portfolio, you can start comparing companies across each other because you normalize against the revenue. You take the weighted average of that and you have the portfolio carbon intensity. Carbon footprint is from the investor's perspective. It is the carbon emissions per dollar of invested, right? In our experience, a lot of European asset owners, investment managers like using carbon footprint. In the US, people like using carbon intensity generally, and they each have pros and cons. Carbon footprint, it more reflects the investor's investment-making decisions, but it's more volatile because there's a market value element to it, right? There's per dollar invested. Carbon intensity is more stable because it's from the revenue perspective. Revenues tends to be more stable over time. So they each have pros and cons, but generally we see these two metrics over time. Okay, so when we work with our clients on their net zero goals, we think there are three legs to the stool, right? There are three key tools that you need to implement. Historically, ESG factors have been incorporated at the bottom up, from a bottom up perspective, at the company level ESG reports. But increasingly, you need to have a top-down strategic asset allocation model as well from a climate perspective. So SAA from a top-down perspective, which I'll talk about in a little bit. From a bottom-up perspective, you have two types of investments. You have your climate solutions, which historically you know well are the renewable or green opportunities that we know all about. But for Asia in particular, there is a huge focus on transitional finance, right? Asia is 50% of global emissions. There's still a lot of coal-based power plants, and you're going to see a lot more frameworks that are focused on transitional activities. This is an important chart. As it relates to investing in emerging markets versus developed markets, I think there's a huge market need right now for decarbonization models that fit the Asian development path, right? I showed the path earlier, 50% reduction of carbon emissions by 2030. That model really doesn't work in emerging markets, where a lot of countries have said that they will peak their emissions in 2030 or 2040. So the Paris Line model doesn't work in a emerging market context. And just to show you a little bit of the math, Europe, which is the green line here, their peak emissions was in 1990, right? So when they talk about 2050 net zero, they have 60 years to decarbonize over time. So they've had a huge head start. The US had peak emissions in 2005. So they have 45 years to decarbonize. And here I show China, but I could show India and Indonesia as well. They have peak emissions in 2030, and they will decarbonize in a very short amount of time from 2030 to 2060. So we all think about the endpoints, but I would argue that the shape of the curve is just as important as the endpoint. And another data point to share, despite Asia being 50% of global emissions, on a cumulative basis, emerging Asia represents less than 50% of global emissions since the start of the pre-industrial revolution, right? So on a fair share basis, there's this debate of what is fair, right? A lot of developed countries have the benefit of developing early on, and Asian countries, should have their own period where they develop before they decarbonize. So it's a big debate in the ESG world as well. Okay, so with all that as background, how do we, Neuberger Berman, perform climate-related analysis? And so we use this tool called Climate Evaluated Risk that was created by this company called Carbon Delta, a Swiss company. We were one of their first clients. They were eventually bought by MSCI. But the way climate value risk is calculated, and they cover about 15,000 securities globally across fixed income and equities. The way it's calculated is there are three components: transition risk, physical risk, technology opportunities. There's two negatives and one positive. The risk side of the negatives, and I'll explain them in a second. Transition risk is your traditional regulatory risk, carbon taxes, a change in in consumer behavior over time, right? Physical risk, as you know well, flooding, typhoons, hurricanes, and the like. And technology opportunities are the green revenues that companies have, and their patents. They're patents that they will develop over time. And so MSCI calculates that into the future. They take the present value of that, and then as a percentage of the enterprise value of the company, so more negative is bad, you can see what the climate-related risk for each security is. And so what we do from an analytical perspective, I'll show it here on the right side of the page, we show the CVAR, climate value risk, for different companies. And you can see at the top right, an aviation company would probably get very hurt by carbon taxes over time, right? So beyond sustainable aviation fuel, they don't have many different ways to decarbonize. So you can do it at the security level. But on the left side of the page, you can actually aggregate it to the portfolio level. And you can see for Neuberger's equity book and fixed income book, in our TCFD report, you can see the actual climate value at risk relative to the benchmark, right? So our blue bar is is not as low as the gray bar. And then you can also calculate it according to different scenarios, climate scenarios, 1.5 degrees, 2.5 degrees, 3 degrees. But you can also calculate it according to different climate transition pathways, whether you look at it according to the Network for Greening Financial System, which is a particular climate pathway, or others. So they give you a lot of choices about how to do that. And it gives you a directional sense of where the risks are in the portfolio. Okay, so I talked about the 3 stools of climate-related investing. From an SAA perspective, we took it a step further, and we took the CVAR of each company and incorporated into our climate SAA. So this is a real SAA where we incorporate CVAR at the security level. The blue line is your standard SAA pre-climate impact. We make an assumption that the blue line represents a 2.7 degree world, which is the world that we are on the path today. And the gray line is the climate-related cost, according to CVAR, for each security in a 2 degree world, right? So in a 2 degree world, there are going to be higher transition costs, and the transition costs get reflected in in a 35 to 45 bips reduction in the efficient frontier. So we actually calculate the efficient frontier over time, and you can see the reduction from the blue line to the gray line here. And so if you look at the differentiation in the CVAR, there's quite a wide variance, right? The CVAR on the bottom right, bottom of the page here, the emerging market equities, you can see it has a CVAR of negative 20%. Why is that? Because, again, I mentioned a lot of Asian countries are later in their decarbonization cycle, but have still very carbon-intensive development models, right? And you can see the U.S. large cap that is very tech-focused, less carbon-intensive type companies, has a lower CVAR. And the way CVAR is calculated is it impacts the equity before it impacts the debt. And so that's why you see a difference between the equity and the debt. And so the top table here, you see the different sectors and the different asset classes. You can see the different CVARs for a 2 degree scenario. And so what we do is we optimize our SAA according to those variances, right? Because you can tell the optimizer to optimize against those different CVARs. And what happens is we find an uplift in the actual efficient frontier, right? You can actually regain about 30 bips of that lost 35 to 45 bips. So we're getting a lot of interest globally from particularly insurance clients on our climate SAA. There's a paper online which you can read. We were a finalist for one of the UN PRI awards, and happy to engage further on this process. So thank you. With that, this is my comment.
Thank you very much, Mr. Nguyen, for the wonderful speech.